Hello and welcome to Investflow. Today we will be talking about the Walt Disney Company, the media and entertainment industry empire that we are probably all familiar with. But is the company just a trip down memory lane, or is it also a good investment? The Walt Disney Company, ticker symbol DIS, is currently trading at a market cap of around $258 billion. They employ around 190,000 people and were founded in 1923. The company is headquartered in Burbank and is in the entertainment industry. Bob Chapek has been the CEO since 2020. If we take a look at the share price, we can see that Disney massively underperformed the general market with a total performance of this target has an upside of 65%. Now let us take a look at the business model for the Walt Disney Company. The main attraction for Disney are their entertainment parks, and we can see they have a large variety of different parks here. The most notable ones probably are the Disneyland resorts, the Disneyland in Paris, and the Walt Disney World. But besides that, they also have a lot of parks in different countries all over the world, like in Shanghai. And they also are operating cruise lines. The entertainment parks and also the cruise lines got impacted very hard by the corona pandemic. As you can imagine, life experiences where there are a lot of people in crowded environments, like entertainment parks and cruise lines, got shut down for over a year, I think. And this really impacted the company in a bad way. The most iconic and biggest parks Disney operates are in Paris, Orlando, Anaheim, Tokyo, Shanghai, and Hong Kong. But they also do have other experiences like water parks, and Animal Kingdom, the Magic Kingdom, and the Hollywood Studios. A lot of these parks, and especially the alternative experiences too, are often bundled together with a normal park. So for example, you would have a water park right next to the normal Disney World. And that also means that they can get people to pay for two different experiences. So we can see a nice little network effect here going on. The entertainment parks and cruise lines aren't the only attraction though that Disney has to offer. They also have a variety of media groups, most notably Disney Plus, which launched a few years ago and has since then taken the world by storm. Then they also have ESPN Plus, which is sports. They also have Hulu, Hotstar, and also a music group. If we take a deeper look into the streaming revenues, we can see that Disney Plus has had a great success with their paid subscribers. In only 3 or 4 years, Disney Plus managed to accumulate over almost 130 million people. In the last year alone, they had an increase of almost 40%. But that is not just the only significant streaming service they have. They also have ESPN with a significant increase of 70% up to 21 million subscribers. And also Hulu, which has two different models. And especially the live TV segment here is interesting, which is also in total growing at a nice 15% for Hulu. But which also gets interesting here is the average monthly revenue per subscriber. And as we can see here, Disney Plus is the lowest with around $4 per subscriber. ESPN Plus has a higher revenue with around $5. But Hulu gets really interesting here because the standard version with 41 million subscribers has a revenue per user per month of $12, and the live TV one actually almost has a $90 per month subscription. Something to keep in mind with Disney Plus is that Disney Hotstar, the Indian service, has around 1/3 of the current subscribers. Because India is a developing country and the people there don't have the same amount of buying power, the average amount of subscription paid is significantly lower. And it also keeps the general revenue per user per month for Disney Plus low. So if they can increase the amount of people in countries with better buying power up, that should also positively affect the margins for Disney Plus. The unique selling point for Disney Plus is the amount of exclusives and originals they can offer there. Disney has a very large catalog of originals and also classic childhood shows which they can offer in their own platform. This is a big advantage over other companies like Netflix that don't have the same amount of IP that Disney has. If we take a look at the different studios that Disney owns, they of course own the Walt Disney Studio and the Walt Disney Animation Studios. They did acquire Pixar Animation Studios for around $9 billion, and they also acquired Marvel Studios and Lucasfilms for $4 billion each. Marvel of course is known for their superhero movies, and Lucasfilms is known for Star Wars. Disney also operates the Disney Theatrical Group, and they did acquire the 20th Century Studios for a massive $50 billion. So Disney has been on a spree buying up studios over the last decades, and now it's really paying off because they can leverage that in their streaming service with Disney Plus. Disney's catalog of old and iconic childhood movies is very vast, and I would probably guess that everybody that's listening to this video has seen at least one of these movies. And I believe that in the future our kids and the future generations will also still be watching old Disney movies. They are also looking to leverage these old franchises again by making them into live action movies. They already had success with live action movies like The Lion King, and are also having a nice pipeline of upcoming live action movies like Peter Pan, Snow White and Bambi. So we can see that Disney is also going with the times and is innovating and is not just rebooting. I mean, they are rebooting the same things, but with a different light as live action movies instead of animations. Disney also has a lot of exposure in the television space with 20th Television, ABC Entertainment, ABC News, and also, of course, the Disney branded television, and also things like National Geographic and Hulu originals. So they are pretty much directly competing with their streaming service against their old entertainment with the television branch. So that is also a good thing that they are not just sitting on their old branches, but also actively challenging and innovating their revenue streams. Sports is also a big thing for Disney with their ESPN platform, and they also have corporations and shareholdings in other companies. They own a big stake in DraftKings, which is a company that focuses on fantasy football, for example, and other sports betting. Some people rumor also that Disney might acquire DraftKings in the future. And then they also have corporations with Fubo TV. Taking a look at the market share for box office revenues in the United States and Canada, we can see that since 2000 the market share generally was on an uptrend for Disney, peaking at around 32% of the whole market share in 2019. The market share can be pretty cyclical though, especially if you take a look at 2020. If the pipeline of new movies isn't good, then this market share can look pretty bad in individual years. But the general uptrend is here, and yeah, if Disney can manage to stay above the 20%, that's a very good thing for them. Disney started to experiment with different ways to distribute their movies and started to directly compete with the cinema industry. They showed some select movies first on Disney Plus for an additional charge instead of in the box office, and have seen some great success. So we will probably see that as a new trend in the future, with new movies not being in the box office, or if they are, not for as long as normal, and instead being available on Disney Plus. So that also gives them a big leverage, or a bigger leverage, because they already have a big leverage over the cinema industry. Disney has a lot of IP, and that also shows in their brand value. They are ranked in the top 10 most valuable brands in the world at rank 10 with around $44 billion, only being topped by companies like McDonald's, some automobile companies, of course Coca-Cola, Samsung, and then big tech. Everybody has been talking about the Metaverse lately, and so has Disney. The CEO, Bob Chapek, has in a memo to employees called the Metaverse the perfect place to pursue the company's strategic goals of excellent storytelling, innovation with a focus on the audience. Several teams in the company are already exploring the possibilities of offering that the Metaverse can bring, and they already started trying out things with the Golden Moments NFT collection and the Mickey Mouse and Friends collection. They also made new job offerings in this direction, so that could be a nice future additional revenue stream to monetize their IP and in general increase their brand value and recognition even further. Before I continue with the fundamentals of the company, I would kindly ask you to thumbs up the video and subscribe to the channel. Also leave a comment down below and let me know what you think about Disney as a company, and if you already own the company or might be thinking about it. Disney managed to grow their revenues just slightly with 3% compared to 2020. The net income went from negative 3 billion to positive 2 billion. Keep in mind though that the 2020 numbers include the start of the corona pandemic when all parks were closed and they had to switch the business model in a bit to streaming. The EBIT decreased a little bit, the equity increased by 5%, and they had a return on equity of just 2%, which isn't that great to be honest. So that's something to keep in mind. The free cash flow decreased in 2021, even though they did get back to profitability. This is something that investors definitely should keep a look at. On the valuation side, we can see that the PE ratio is pretty high right now. The company was trading at around a 20 PE in 2019 and is now at a 80 PE with a forward PE of still a 33. The price to book ratio is still the same roughly. Price to cash flow went up from 33 to almost 50. There you can't really calculate a PEG ratio because they had a negative net income year in 2020. The Petrovsky F-score massively increased though from 3 out of 9 to 7 out of 9 points. In the last 5 years, Disney has kinda struggled fundamentally. Revenues did increase around 22% in the last 5 years. Keep in mind though that the corona pandemic dampened this a lot, and without that it would probably be somewhere in the 70 billion range. Net income went down a lot from the levels pre-pandemic, and free cash flow also did start to drop a lot even before the pandemic. So fundamentally, it's not looking too great right now, but it's just past performance and doesn't tell us much about the future. Last quarter's revenue was split in 1/3 parks and products and 2/3 media and entertainment. The company does have a large debt with a 33 billion net debt position, with an EBITDA of almost 9 billion. This means they have a financial debt ratio of almost 400%. I currently want to have the upper limit for that at 200%, so Disney is a lot above that. A lot of the debt came from the pandemic though, so keep that in mind. The company is highly leveraged right now. The company also massively diluted shareholders in 2019, where the share count went up by around 300 million shares. Looking at the guidance, analysts are pretty bullish though. They are expecting revenues to almost double in the next 3 years to over 100 billion. In the same time, net income is estimated to go back to almost to the pre-pandemic levels. but still trailing a little bit. In 2019 they had 11 billion in net income, and the 2024 estimates are 10.5 billion. So EPS would still be down a good bit compared to 2019. The analysts also are expecting that Disney will start paying a dividend again by 2023. I personally really like that they cut the dividend. A lot of other companies kept paying dividends in the pandemic even though they shouldn't have. And they also focused on putting out a good streaming service, which they did. To summarize, Disney does have one of the best brands in the world. They did overcome the COVID crisis pretty well and are broadly diversified in a lot of different entertainment sectors like parks, like movies, streaming, television, and also cruise lines. They do have a good future outlook, but on the other side they're in a fiercely competitive market with a lot of new companies also getting into the movie business like Amazon and Apple lately. They have a high valuation and have a pretty bad balance sheet in my opinion. If we take a look at their moat, on the technology side they don't really have much of a moat. They do have one of the best brands and one of the largest company histories in the entertainment sector. So for brand and experience they do get the highest score on the moat scale. So let's take a look at my outlook for the company. They have a very strong portfolio of brands. Live action adaptations can be a new and relatively sure guarantee for success. The entertainment parks are getting back into their old levels of operations. The balance sheet does look pretty bad though. They have a lot of debt on their partially from the corona pandemic and the big losses they had to take there. The film business in particular is highly competitive and the flop here can be very costly. Shares currently are pretty highly valued, but they are expected to pay a dividend soon again and will probably get back onto their feet from the net income perspective and hopefully also free cash flow. I personally think Disney is a good company to put on your watch list. For me it's just way too expensive right now. Looking at the past performance, it wasn't really too great in my opinion. Profitability has stalled pre-pandemic and free cash flow also went down a lot. In general they have a lot of potential though, with the streaming service giving them a nice recurring revenue stream. They also can leverage their position with the cinema industry better with Disney Plus. So a lot actually depends on Disney Plus and how they can manage to leverage that and continue to grow it and to compete with other services like Netflix and Amazon Prime for example. So hope you did enjoy the video. Once again, please subscribe and leave a comment down below.